Earnings season, that is off to a full swing start here. And last week we saw major banks coming out. Tesla, they released their quarterly earnings as well, and so did Netflix. And now the much anticipated big tech earnings are set to be released throughout the week here. But what can investors take away from results this season, and what should they be focused on? Let's bring in Avondale Asset Management founder and editor of the Transcript, Scott Krisiloff, to give us his insights into what we've been seeing so far. Always great to see you here, Scott. And you've been perusing the transcripts, as I know you have, and we got some big bank earnings. The tone pretty good with respect to the consumer and the economy so far. Recession potential down the line. Just a smattering. What have you been seeing here?
Yeah, I mean, it's more of the same that we've seen for the last couple of quarters, which is a resilient economy, a resilient consumer. I think there's a lot of optimism still. I think the biggest, most noteworthy thing that we saw in the last week was that capital markets seem to be ready to start opening as well. Banks like Goldman Sachs, Morgan Stanley talking about robust pipelines in their investment banking business, really starting to see optimism come through.
Yeah, I've noticed I go down to the New York Stock Exchange every day, seen some big high-profile IPOs in the market. Want to talk about some other stuff that's happening, huge trends in AI, resurgence in interest this year, or I should say surge in interest this year. How are companies talking about AI on their earnings calls?
Yeah, I think there's a lot of interest in AI. Obviously, it's been a big driver of capital markets, our tech companies and the NASDAQ. Really getting a boost from AI expectations. I think one quote that really stood out to me was from Taiwan Semi, which we had in our newsletter this week, which talked about how the short-term hype in AI is something that may not carry through in the medium term, but is likely to persist in the long term, that the AI wave will continue to grow. But short-term expectations are extremely high, and that isn't necessarily working its way through to earnings, even for the semiconductor companies in the near term.
Yeah, it seems like that's going to take years to play out, but that's just my opinion. Also want to get your take on the residential real estate markets. We've seen mixed figures out of housing, but despite mortgage rates at 7-8% in some areas, we still see huge demand for housing.
Yeah, that's an incredible dynamic that's happening in the housing market. It's tough to explain, honestly. Mortgage rates up a lot, but still demand there. I think the biggest contributor to it is the fact that supply has been held low. And in some ways, higher mortgage rates are contributing to that. So if you already bought into a house, have a lower mortgage rate, it's hard to move and justify going to a much higher rate. So that's helping to keep supply low, which is helping to keep prices supported. But even demand is staying strong, it appears, despite these high interest rates.
Yeah, and just thinking about the Federal Reserve, which goes hand in hand with the rates, those are longer-term rates. When we think about the Fed, we think about short-term rates. Lots of expectations for this week's big announcement, but the consensus is that that the Fed hikes this week. But then, are they done? What are some of the banks saying on the transcripts?
Yeah, I mean, I think most companies are expecting for the Fed to hike one, maybe two more times, but really focusing in on one and then pause for a while, which is exactly what Jerome Powell has been trying to say to markets, get markets behind, is that interest rates may stay higher for a little bit longer in order to fight inflation. But I think people are thinking that we're pretty close to the end here on the interest rate increases, which I think is probably part of the reason why stock prices are a little bit more buoyant this year as well.
Yeah, and the proof remains in the pudding. We'll have to see what comes this Wednesday. We're going to be bringing that live for everybody. Also want to talk about the international front, especially China, the reopening. We know by now it's taken a lot longer and has been a lot slower than anticipated. Any signs that it's picking up, or is there just a general malaise over there?
I think we're still seeing a general malaise over there from what we're picking up in earnings calls. I think that as much of the story about China reopening and the obviously draconian COVID policies that they followed for several years, I think international companies are hesitant to be investing in China with the geopolitics in the country today. And so you're actually seeing one of the trends that we think is most interesting is the nearshoring, onshoring, reshoring of industrial capacity. In the United States, North America, one of the countries that's benefiting is Mexico. And you're also seeing companies do that in Europe as well. But I think without as much foreign direct investment going into China, that's probably helping to slow their economy as well.
And circling back to the consumer, you're noting in some of your writings today, there are elevated delinquencies in auto, loan growth slowing in other areas. So the consumer, as we have been saying, is resilient, but there are some maybe warning signs on the horizon.
Yeah, absolutely. I think the way that we are interpreting this at this point is just a general slowing of the economy. But on a nominal basis, inflation adjusted, or including inflation, the growth rates were so high for the last couple of years that even if you come back to 5, 4, 3% growth even, which is a more normalized growth rate, it feels like it's much slower than it was. And it is a slowdown. It's a quantitative slowdown from where we were. But that doesn't necessarily mean we're seeing negative growth at this point or recessionary type dynamics.
Excellent to point out there and noted. Thank you as always, Scott Krisiloff, Avondale Asset Management founder and editor of the Transcript.